In this chapter, we will be talking about the elimination of unrealized profit on intercompany sales of inventory. So the whole idea here is that you cannot sell to yourself. So if we have a consolidated entity in which our parent and subsidiaries are selling inventory to each other, none of those sales count until the product has left the consolidated entity. For the purposes of our class, we're going to focus on a retail setting. That's the sales of inventory. So one company purchases inventory, holds it for some period of time, and sells it later at a higher price. We're not going to worry about manufacturing or sales of goods or sales of services in this case. One thing we're going to talk about a bit is that the direction matters. So upstream versus downstream versus horizontal are our options. So if you take a look at the triangle on the right side of the screen, we have our parent company at the top because they're at the top of kind of our hierarchy of this company, and we have our subsidiaries down below. So if our parent is selling to our subsidiary, then that is a downstream sale because they're selling down our triangle. But if our subsidiary sells to our parent company, then that's an upstream sale because they are higher up in the ownership hierarchy. If our subsidiaries do business with each other, those sales are considered to be horizontal. Once inventory is sold outside of this triangle, then it's okay to recognize the profit on that sale. But we cannot recognize any profit on sales between the entities in our triangle until that time. So for an example, let's say that our parent company sells inventory to one of their subsidiaries at a markup. If our subsidiary is holding that inventory at the reporting date, then we need eliminating entries for that unrealized profit. It becomes realized once it's sold outside of the consolidated entity. So once that subsidiary sells the inventory outside of the consolidated entity, then we're going to bring that profit back into the mix because now it's realized. If you look at the small chart at the bottom right, we see that in the first column, our parent is selling to our subsidiary. And so let's say they have sales of $120 and their associated cost of goods sold is $100. So they purchased goods for $100, marked them up by $20, and then sold them to their subsidiary for a profit of $20. When our subsidiary gets those goods, their cost of goods sold is $120 because that's how much they bought them for. They're also going to mark it up $20, and they're eventually going to sell it for $140. What we want is for our consolidated financial statements to consider the cost of goods sold when the goods entered our triangle, so that's $100, and the sale price when it exited our triangle, which is $140. So overall, we're looking at a profit of $40,000 for the consolidated entity. One thing you'll notice in our book is that there's some sneaky wording regarding markup. So usually we're given the amount of unsold intercompany inventory in the year-end balance. And so those are the sales that don't count yet because we're still holding them within our consolidated entity. But we need to convert this to profit because it's the markup that's a problem. However, our book has two different ways of describing it. One is as a percent of selling cost, and one is or percent of selling, and the other is as a percent above cost. So to get to markup, if we have percent of selling, we take our unsold inventory and multiply it by the percentage. That gives us the unrealized profit. However, if we have our markup described as a percent above cost, we have to take our unsold inventory, divide it by 1 plus that markup rate, and then subtract that cost from our unsold inventory to get to the profit. This, for some reason, blows my mind. And so every time I do one of these problems, I use the cheat sheet to the right to do it in multiple steps, calculating first unsold inventory if they haven't given me that number outright, then calculating the cost of that unsold inventory, and then finally calculating the profit. We're going to start with an example of downstream sales. In this example, our parent company owns 80% of the outstanding common stock of S Company. During 2019, S Company reported net income of $525,000 and declared no dividends. At the end of the year, S Company's inventory included $487,500 in unrealized profit on purchases from P Company. Intercompany sales for 2019 totaled $2.7 million. So on the left-hand side, we see that this is a downstream sale where our parent, which is marked in yellow, is selling to our subsidiary, which is marked in blue. When the sale happens, our parent is going to debit cash and credit sales for 2.7 million because they're receiving cash from the subsidiary of 2.7 million and their sales price was the same. They're then going to transfer inventory from their balance sheet to cost of goods sold. In this case, I've backed into the amount of cost of goods sold, which is $2,212,500. On the subsidiary side, they're paying 2.7 million, so their cash is credited as it goes down, and then they're debiting 2.7 million to inventory to record the goods they've just received. So from an eliminating entry perspective, what we need to do is we first need to get rid of the sales because you cannot sell to yourself. So our parent credited sales for 2.7 million. So to eliminate that, we're going to debit it by 2.7 million. Then we need to also get rid of the cost of goods sold that's affiliated with that transaction because again, we cannot sell to ourselves. The cost of goods sold was debited 2.2 million and change. So we're going to credit the same amount. We don't really care about the cash because the cash is going to be added into our consolidated balance sheet, whether it's on the parent's general ledger or the subsidiary's general ledger. It's all going into the same place on our consolidated balance sheet, and we want that cash. So that part's fine. We're not worried about it. However, the inventory in the process of this transaction has increased in value from what it was on the parent's book at the 2.2 million up to what it now is on our subsidiary's books at 2.7 million. So the idea here is that we don't want that inventory marked up when it hasn't left our consolidated entity. So in order to mark it back down to the price it entered the consolidated entity at, which is the 2.2 million, we're going to credit inventory to back out the profit that our parent company recognized on the sale of those goods to S until such time as this inventory leaves our consolidated entity. Unfortunately, we can't use the eliminating entry that I just described, which would be too logical, because unfortunately our book authors have changed our income statement format so that our cost of goods sold line is now broken up into 3 different lines that will then calculate cost of goods sold basically using the periodic method of inventory. So the periodic method of inventory states that we start with our beginning inventory. We know what we have. We keep track of what we got, our purchases, what we've added to it. And then at the end of the year, we count what we still have and we subtract it out. And whatever is missing must have been sold. So we're essentially going to do this on the face of our financial statements, which means that our eliminating entries to cost of goods sold must specify which part of this entry we're adjusting. So our options are beginning 1/1 inventory, purchases, or ending 12/31 inventory as part of this cost of goods sold calculation. We also need to be a little bit careful because remember, we're still going to have ending balance of inventory on our actual balance sheet. So we need to be very careful specifying where we're adjusting our ending balance of inventory. So what this does to the eliminating entry that I just described, what we're going to do is we are instead going to break up our cost of goods sold portion of the eliminating entry into 2 parts. So we're going to debit sales, as we did in the previous example that was, logical. And then we're going to credit purchases for cost of goods sold. So this is an intercompany eliminating entry. And so we're getting rid of the sales recorded by the parent and we're getting rid of the purchases recorded by the subsidiary. Then in the second entry here, we're basically just marking down inventory back to where it should have been without this markup during the sale. So we're going to reduce the inventory by crediting 12/31 inventory on the balance sheet by the amount of intercompany profit or the amount of markup that the parent made on that inventory before selling it to the subsidiary, which was the $487,500. Then the debit here is going to be to ending inventory where it appears on our income statement to make sure that the calculation of cost of goods sold also has that amount removed from ending inventory. Continuing our example with downstream sales, in the following year, now those goods are finally sold outside the consolidated entity, and now the profit can be recognized. So what's going to happen is our eliminating entry is going to adjust our 1/1 inventory of uh, on our income statement in that cost of goods sold calculation, essentially putting it back where it was at the end of last year's consolidation so that our beginning balance of inventory matches our ending inventory from the previous consolidation. Then the debit side of this is going to depend upon whether the parent company was using the cost or the equity method. So as we've seen in previous chapters, when our parent company is using the cost method, the prior year income statement effects that we're adjusting are going to be to 1-1 retained earnings of the parent, whereas under the equity method, any prior year income statement effects are going to be to investment in S. Again, remember that we are only covering the complete equity method, and so if you see something in the book about partial equity method, that could be a little bit different. From here on out, let's go give this a try in our next example.